Next up, I'm very excited. Our next speaker is Faisal Aftab. He is the co-founder of Zayn Capital, a leading Pakistani VC. He's the managing partner of Zayn Bitrate Fund, a venture capital fund with a primary focus on early stage ventures in Pakistan. He's invested in over 20 killer startups, so you want to meet him. These startups include Laam, Bachelor, Roomy, NayaPay. He's an early Bitcoin and Ethereum investor. So fintech innovators, you want to hound him when he's off stage. Please, are the mics ready? Mics are not ready yet. But Faisal is ready, that's good. So put your hands together for a big, warm welcome to Faisal Aftab.
All right, so first of all, I'm Faisal Aftab, co-founder and GP of Zayn Capital's Bitrate Fund. I'd like to thank Jahara and the Catalyst Lab team for having me here. It's really an honor to speak here, so thank you so much. Okay, so everybody's like really worried I'm going to be very bearish, which I am, but not too much. But I think what I was thinking earlier before I go into this talk is maybe let's talk about history a bit. It's always good to see where we came from, to see where we're going, to try to predict the future, because everything is speculation. So if we go back to the last major disruption, which was the industrial age between 1914 and 45, the industrial age disrupting the agrarian age. And fast forward to 1995, the same thing is playing out, where tech effectively, or the information age, started disrupting the industrial age. And we're in the middle of it, so this is going to only accelerate from 2022 onwards. Again, I'm going to go back to history and look at what was happening at the monetary system level. So from 1914 to 45, the reserve currency was the pound. And the dollar ended up disrupting the reserve currency at the time and became the reserve currency in 1945. In our current world today, the same thing is playing out, where we're sitting at a moment where the reserve currency, which is the dollar, is facing potential challenges from other settlement systems, as well as rising powers such as China that are aligned with other powers in the world, such as Russia. And we're all aware of what's happening in Ukraine. So that's all part of the monetary system. And believe it or not, it's also linked to the current changes in technology, Bitcoin. The whole thing is interlinked. And I would say the SWIFT system as well. So let's dissect the history of the internet as well. So the internet was launched in layers, in protocols. So in 1995, or early 90s, we had DARPA effectively give the first protocol, which is the TCP IP layer, which was bound by capacity, let's say dial-up. So the first data layer disruption was email disrupting postal services. And so it was basically written communication was being, postal communication was being disrupted by digital communication. Now we moved on, then the second layer, somebody said, hey, let's get voice on the internet as well. So we had the voice over IP layer disruption. And as an investor, by the way, you want to be investing in the underlying disruption at each point in time. So in the voice over IP layer, we had long distance disrupted by platforms like Skype, WhatsApp, Viber, and all the iterations. And they impacted companies like AT&T's long distance revenue, or even PTCL. They used to make a ton of revenue from long distance, and I think they might still make some level of it. But at least most of us are on WhatsApp or Botim. Let's move on to the next layer of disruption, another protocol layer that was being developed. That was the video over IP disruption, and that's still happening. In some parts, it's happened quite aggressively. In our part of the world, it's now picking up steam. So at that point, platforms like Netflix, YouTube, and social media are taking over in terms of your television consumption. So it's disrupting satellite and linear cable television channels. There was also obviously mobility as a disruption as well. When we got a hold of a smartphone, we started having the shared economy. And so I won't go into too many iterations of it, but I'm trying to set the context to understand why suddenly there's a liquidity squeeze. So we'll jump straight into that. So we're in probably what I think is the most profound change in the technology, the history of technology, which is money itself merging with the internet. And that's why I was giving a context of the dollar disrupting the pound and what's coming up ahead. So in the exchange of value disruption, it's not just simply cryptocurrencies. That's just one element. We're effectively creating a cashless society in which you need to emulate the entire financial and monetary system. So let's start with the base of the monetary system. Historically, it used to be currencies were backed by gold till about 1971, and then we moved to the 10-year US Treasury. Now, the reason why understanding the 10-year US Treasury is so important is because that forms the foundation of our current monetary system. So when the rupee devalues, it's really the interest rate on the 10-year Treasury that is determining the strength of the dollar or the weakness of the dollar. And that's controlled by the central bank in the US, similar to our state bank, called the Federal Reserve. Now, the Federal Reserve is much more powerful because in terms of world trade, the dollar is the reserve currency, along with the euro, the pound, and the yen. If you want to actually transact in the international banking system, which I call the analog system, you have to wire money in one of these four currencies in order to basically trade between, let's say, Pakistan's trading with Saudi Arabia. We're selling wheat, and they're selling us oil. Instead of a barter, we're actually buying dollars since they only accept dollars. And so that's the whole settlement system that's going into now what we're living through at this moment. Suddenly, we had a major black swan event in March of 2020 with a pandemic throughout the world, and reserve central banks decided to print, there was no other way. You had to stimulate the economy. Everybody was in a lockdown. And they printed something to the tune of, the Federal Reserve alone printed $7 trillion. The European Central Bank, another very important central bank, printed, I think, somewhere around another 6 to 7 trillion. The Bank of England did as well, so did the Bank of Japan, and even we did. Everybody stimulated. Well, the lag effect of that is that money, when it's printed at such a quantum scale, and to put things in context, since George Washington till now, the US debt effectively is 31 trillion. But 7 trillion of that has been printed just in the last 2 years, and that's why you're seeing inflation everywhere. So effectively, in Pakistan, we are used to high inflation. When I say high inflation, 10% plus. In the US, they're used to 2% inflation, and most of the developed world. So with a lag effect, what you saw was inflation showed up in the system by the tail end of 2021. Now, what is inflation? Inflation is what we saw in the startup ecosystem, where money, fungibility-wise, that was printed, had to find a home. So people took bets in the stock market in the US. People took bets in housing in the US. In fact, people even took bets from the US and the UK into housing in Pakistan. That's why there was a housing bubble in Pakistan last year. I think Karachi, Lahore went up first, then Islamabad, and everything was in a massive bubble. So effectively, the Federal Reserve realized that, wait a minute, this inflation, which we always want, because our system is dependent on inflation in order to stay afloat, is getting out of control because it can very quickly turn from single digits, 9.1% was the peak US inflation, into double digits, and it can go spiral into hyperinflation because of the effect of money printing. So the Federal Reserve in October of 2021 gave something called forward guidance. And I keep going back to the Federal Reserve. They're more important to us than our central bank. Since most of our reserves are in dollars, and as I think most of us in the last year have seen, that even $1 billion coming into Pakistan stabilizes the economy. So when they decided that we need to fight inflation versus their primary mandate historically, which was 2% inflation, which changed significantly, so they decided we're going to target unemployment and raise rates versus keeping rates low. The second they started raising rates in March, with a 6 to 9 month lag effect, we started seeing liquidity squeezed out from all markets, including the US, but more specifically Pakistan, because Pakistan is a frontier market. Now let's dissect Pakistan in terms of funding, so it'll help everyone here understand how to raise funds and how to target fundraising. So in the case of Pakistan, there's about 5 to 6 dedicated funds. The rest of the funds that invest in Pakistan do not have a dedication dedicated mandate for Pakistan. So they were actually investing from their 10% opportunistic allocation. And I wouldn't even say they were investing 10% of it, they were investing a fraction of that money. That component is gone. The local funds are the ones that have to support the ecosystem. Now within that, all of us are in different stages. Some have a lot of dry powder, they're on fund 2. Some are in the middle of their fund, and some have run out of money. And they're in the process of raising the next fund. But so as a founder, when you're raising in this recession, because the opportunistic money has disappeared, it is not going to come back to Pakistan until valuations around us go up and become unattractive. And then Pakistan, with its incremental risk on top of the venture capital risk, becomes attractive. So if I had to trace this entire equation, I would put it somewhere to the effect that money, realistic money like what we saw in prior to 2022, I don't think comes back to Pakistan till about Q2 to Q4, Q2 to Q3 of 2024. And for the reason is, if I'm an international fund and I find a deal that's very attractive in the MENA region with a low valuation, I'm going to go there first because the chances of a macro risk default at a sovereign level is much less there than it is in Pakistan. And the same thing goes to India, Southeast Asia. So you have to look at the comparable economies around us in valuations. There's also that lag effect that in my personal opinion, venture capital money is going to flow aggressively in the world. The second the Federal Reserve, and you have to keep an eye out if you're a founder for this word, decides to pivot, where they stop raising rates, they pause, and then they cut at some point. So pause is going to be a pivot, where they take rates, let's say, to 4%, leave it at 4% for probably about 4 to 5 years. Just to put that in context, for the last 12 years, we've had a near zero interest rate environment. So having rates at 4%, which sounds low in Pakistan, but for the dollar denominated borrowings, it's actually really, really bad for the global economy with debt. So keep an eye out on that cut. When they first cut, and I think personally this is all speculative by the way, they're going to cut gradually, not drop down to zero like they've done in the past. That's where venture capital money, that's so much money has been raised in 2022, is going to start investing. They're going to first start investing, though, in their home markets and in other markets with less risk than Pakistan. And then wait till valuations come up and then front run into Pakistan. So now who is going to be able to raise money? And let's come and think about where people sit in terms of most of the people in this room that are looking to raise. Look, if you are an early stage founder, pre-seed, an idea and a team, I think you should plan to raise money that can last you at least 24 months before you're going to see that incremental check to continue to scale. To give you a comparison, in 2021, that was happening every 3 months. Now you need to have 2 years to basically get that incremental capital. If you're a Series A company, I think you potentially have the toughest exposure in terms of incremental capital, because those type of funds are not going to be available. So what I would do is extend the runway and try to make it till June 2024, or try to bring in a strategic, look at some M&A activity, and survive in that manner. If you're a growth stage company, it gets even tougher. Now, with this said, from a growth stage company, they need big checks. They need $30 to $50 million checks. Those investors just don't exist for Pakistan right now. There are a few strategic MENA investors that may look at Pakistan, because Pakistan, for them, Pakistan and Egypt is strategic. But obviously, they're going to pick the bigger players in Pakistan. So companies like Abhi Finance, Bazaar. In my opinion, these companies are safe. And I'm not just saying this in my own portfolio. I think there's others in other portfolios as well that will probably they'll look at and feel comfortable because the controls are in place. But as a founder, the way you have to play this is avoid what happened, avoid thinking about how the past has played out. It's going to rhyme, but it's not going to be the same going forward. And I think our cycles have also changed. So historically, we've had 7 to 10-year bull runs. Because we're at the tail end of this monetary system that we've been used to since 1971, where the dollar alone is the reserve currency, I think the battle is going to accelerate between Russia in Ukraine, China, and the US as we move to a multipolar world. which is going to result in economic cycles being shortened. So you're looking at effectively 3 to 4 year cycles where you have high rates, then you have lower rates, then you have higher rates. And so as founders, if you're building a company or you're raising capital, you're going to have to become very well versed in riding these business cycles and economic cycles to build a good company. With that said, I think I'm almost out of time. So I'll just leave you with a final thought that at the end of the day, whatever idea that you decide to execute, the key is to focus on the execution over a 10-year period. And the second you think long-term, you automatically then start to understand these short-term, these mid-term and short-term cycles to build your company. Thank you.